Time for Hot Picks. We're zeroing in today on three non-bank financial names. We are joined by Ryding, equity research analyst covering diversified financials at TD Securities. Thanks very much for joining us. Can we just start off with Power Corporation? Why do you think this Desmarais family holding company is a decent bet?
Thanks for having me. Sure. It's a large cap stock, so it's a good defensive name in this sort of environment. It's a holding company that has a majority stake in Great-West and IGM, and then they've got some other assets around that. My TD colleague, Mary Mendonca, who covers Great-West, he's positive on that name. He cites the momentum it's got in its U.S. Empower business, which is retirement admin and wealth management, and its relatively defensive profile. And then similarly, IGM, which is another sort of core holding, IGM Financial, Canadian asset manager. It's got a lot of scale, over 250 billion in AUM or AUA, and it's got a proprietary wealth distribution channel with IG Wealth, and that's over 50% of its earnings. So we think that should hold up pretty well in a volatile market. And then in terms of just thinking about the investment case, it's the company's targeting high single-digit earnings growth. They pay out a 5% dividend yield. So investors should sort of expect kind of low double-digit return without any valuation change. And, that would be supported by both Great-West and IGM targeting high single-digit earnings growth. And then from the rest of their NAV, so sort of 7 to 10% of their NAV, they're sort of targeting 10% returns on these co-investments that sit alongside its alternative asset management business. And the last thing I would say is they're buying back a lot of shares. So they did 430 million last year. They still have 1.6 billion of cash on their balance sheet as of the end of Q4. So we think they're going to remain active in 2025, and we have seen that in the first quarter. They bought back 116 million in shares.
And the dividend goes up pretty steadily. They were paying less than 50 cents a share quarterly in 2022, and that has now jumped to 61 cents. So it goes, that income stream increases. Can we get to your next name? Element Fleet Management, a huge player in helping companies manage their array of cars.
Yeah, exactly. Largest publicly traded auto fleet manager in the world. 2/3 of their business is in the US and Canada. 1/3 is in Mexico and Australia, New Zealand. Pretty constructive guidance for 2025, high single-digit top-line growth and low double-digit forecast for EPS and free cash flow per share. And we think that actually matters because this company has a very strong track record on delivering against guidance. They've raised or beat guidance every year now since 2022. So they've got some credibility on that front. And the other thing we really like about this name is there's a long runway for growth for pushing into the self-managed fleet market. So in other words, the portion of the market that is not being outsourced to a fleet management company like EFN or its competitors. And the company estimates in the markets they're in, it's like 55 to 65% of the markets are today self-managed. So there seems to be a very long multi-year runway for growth if they can continue to penetrate that part of the market. Now they're not going to be immune to potential tariff related slowdown or a recession, but we do think there's some components of its business that we think would be quite resilient. If inflation picks up and you start to see higher vehicle prices come through, we don't think corporate demand for auto fleets would be as elastic as consumer demand. So, these assets are often, very mission critical to the logistics needs of the businesses. So those higher vehicle prices would actually get passed on in the form of higher average earning fleet assets, and from that they earn their net financing revenue. And then on the capital light sort of fleet servicing side of the business, so that's about 55% of their revenue. It's really just a cost plus revenue model. So inflation largely would get passed through in that environment as well. And then similar to Power Corp, it has a track record of growing its dividend, and they return a lot of capital to shareholders through buybacks. And we saw that again in Q1.
We're tight for time. Sorry about that. goeasy, they're a provider of credit for people who have trouble accessing the normal banking system. Why do you like this name?
This would definitely be more of a risk-on type idea. So not necessarily for right now, but when we do get to a point of less uncertainty around tariffs and growth, I think this name should be on people's radar. Very strong growth profile, 20 to 30% growth rates for loan growth, revenue, EPS. And we think that, that can continue. The firm is benefiting from increased scale, so you can see margin expansion with this business, very healthy, 25% ROEs, and there's a track record of credit losses declining over time. The key risk here is obviously the credit loss, and there is some earning sensitivity with this business to credit losses, particularly around a tariff-related sort of slowdown or recession. So on that front, we do think in Q1 you're going to see lenders, including goeasy, probably increase their provisions for sort of the weakening trends we're seeing in macro conditions. Employment, we're sort of seeing consensus start to move its forecast for the unemployment rate higher. So we think, consensus probably needs to come down for Q1. So tactically, maybe investors should sort of wait and sort of see how Q1 plays out and then look to maybe get in and add to the name after Q1.
Thank you very much indeed for joining us.
Okay, thanks for having me.
Graham, thanks. Graham Ryding, equity research analyst covering diversified financials at TD Securities. After the